We've got Suresh Ganapathy on that note of Macquarie Capital. Suresh, good morning. What a morning, right? You put out a report, the stock gets beaten down, and the header of your report says fighting for survival. You've not only just cut the target price, but you've said that they will be struggling. You want to just take us through the interns of why have you cut the price down to 250 from the current around 400 rupees? So that's a 35% downtick from yesterday's close. What are the key concerns here?
Yeah, sure. So I think what we have always been telling here is that the most important business for Paytm continues to be its financial services business or its lending business. That is the partnership that it has with all the lenders, and they do have a great set of data, which and of course technology also, which they used to leverage and act like a good digital DSC and source these customers and give it to the lenders, and the lenders are happy paying them a certain take rate. No, the problem here is what's happened here is because of the restrictions which are imposed, which have been imposed on the Paytm Payments Bank, there is clearly a worry that there could be exodus of a lot of customers as well as the merchant ecosystem. If that indeed happens, clearly the lenders will have to reevaluate their decision or relationship with the with 197, which is the parent company of Paytm Payments Bank. Now, our channel checks reveal that indeed is the case. The lenders are reevaluating their position with 197. Could be for a variety of reasons. One of the lenders, largest lenders, has already reduced their exposure to Paytm by from 2,000 crores at the peak down to 600 crores now, right? So you have seen significant scale down by the lending partners, and there is a possibility that there are more in the pipeline, and at least some of them have obviously kept lending in a limbo for the time being. So all that is actually will have a corresponding, catalyst effect on the entire company and its business model of a profitability model. So the call that we have taken very clearly is the fact that there will be a significant reduction in the distribution business revenue, and that, remember, is the highest EBITDA contributor in our view. And in the issue of the fact that these numbers can come down quite significantly, we of course have changed our view and accordingly cut our target price to $275.
Right, Suresh, this is Vishwanath here. The question that I think a lot of people seem to be wondering is the future of the parent app with regard to where the payments bank is. But your report mentions the lending part, which of course you detailed just now. I wanted to get a sense as to, when the restrictions came in, the company came out and said 300 to 500 odd crore worth of hit on EBITDA. But it seems that the hit or the pain is going to be far more, far deeper and far widespread than previously anticipated when they spoke to the analysts.
Our view, obviously the company's view could be different, but note that at the end of the day, the impact is based on certain things which you can't do. But what about the impact which is coming from the fact that in future you will lose customers and you will lose certain proportion of your lending business? That obviously no company can quantify and be more futuristic, and that's the call of analysts like us, right? So we are taking a call that there can be a reasonable exodus of customers as well as merchants, and that could have a significant implication with respect to their lending abilities, and consequently that this segment of the revenues will also get affected and consequently profitability. So the 300 to 500 crore impact doesn't take into account a lot of futuristic developments which could very well play out not necessarily as per the management's expectations, right?
The one part that came out, we reported here as well as some other news reports out there talking about compliance-specific issues. What seems to be playing out is also a reputational problem, apart from, of course, the financials and the impact of these norms on the customer base. The reputational hit, of course, also impacts future business relationships. Just take us through what could maybe hit Paytm through because of this reputational problem.
It's already seen in the case of the fact that the lenders are relooking at the portfolio or the relationship that they have got, right? And also the fact that because of whatever issues that has happened and Paytm Payments Bank operations have been severely restricted by the Reserve Bank of India, what's happening here is any new onboarding of customers will also require a very detailed KYC check to be done. So it is not that tomorrow Paytm can get up and sell their crore merchants to the banking players, right? Any bank who is going to take for example, the nodal accounts from Paytm Payments Bank, they will have to do their own significant due diligence and KYC of each and every customer or merchant that they are onboarding. That makes the entire process cumbersome. And that's a function of some of these regulatory actions and, as you said, the reputational issues which have been brought to the fore.
29th February deadline then seems very tight considering the task at hand, right?
Yeah, of course. Yes, it's a difficult. I mean, that's what we don't know. The media was speculating. You guys were speculating that he went and met Reserve Bank of India and Nirmala Sitharaman, Finance Minister. So
Yeah.
obviously, I guess that close shows the gravity of the situation as to why, I mean, those kind of meetings, as per the press reports, were required because maybe there's some relaxation that they sought out for. But clearly today also, Reserve Bank of India governor has gone ahead and said that there is not going to be any rethink on the decision and it's final, right? So,
Right. Suresh, so all of this that you mentioned, you obviously don't believe is already in the price, right? And hence you've downgraded the stock
That's right.
to levels of 250 odd.
Yeah.
When you looked at the valuations of this, up until the early Jan, you could get multiple businesses for 197 communication in terms of pricing and valuation. From where it stands right now, and when you value the company or value 197, is that 250 rupee price per share only valuing or taking into consideration the UPI app that may be untouched or may survive for now at least?
No, first, my target price is 275, not 250. Just a technical correction
Thank
there.
you.
But yeah, no, but look, I think we were always of the view that whether it is UPI or whether it is wallets or whether it is various other commerce services and soundbox services that they provide for their merchants, everything at the end of the day boils down to, more like an EBITDA neutral kind of a position, because obviously they also have to make a lot of tech investments. And that helps them to retain the customers in the overall ecosystem. And on top of that, they build their lending business, right? So the call here is that you actually monetize your lending business in a big way. And obviously the other businesses are just barely breaking even. The highest margin is on the lending business. Now, the fact that, customers may come to the app for using UPI, which is still allowed, that's not, nothing stops them from using just like a Google Pay or a Phone Pay, except that at the sponsor bank level, there may not be Paytm Payments Bank and maybe some other bank which is there, which is the case with Google Pay and Phone Pay. But then my point here is then how you are different, right? At the end of the day, your competitors are also doing something similar. You're just aping them in a way. And you of course had a great advantage of being a two-way ecosystem player between the merchants and the consumers. The fact that you can no longer maybe sustain that to the same level as you had before this payments bank restriction makes life even more difficult with respect to getting the right kind of customers to monetize or leverage and sell it to your lending partners. That's where the challenge lies in.
Suresh, now let's do this, right? Let's do a little more forward-looking discussion here. A few quarters out, assume the dust settles, the stock continues to correct, goes on all the way to 270, 300. Now at that stage, does it then become a buy? A, and B, in the interim when it goes down all the way from 400 to 270 or even sub 270, what would it take for you to reconsider your rating on this one? Could there be any option or opportunity of a re-rating for Paytm? You've also talked about a bull case and a bear case, and in the bull case, the implied valuation from what I see is 540 rupees. So there is still that chance, is there?
No, of course. Look, I think let's go look at it in this way, right? Numbers, what the investors should look at. They generated about 600 crores of quarterly revenue for the distribution side of the business, which is the distribution of financial services, predominantly loans. Now, if you were to annualize it, that comes out to be 2,400 crores. Our numbers take into account a 50% reduction or 50 to 60% reduction from that level. Now, the call here is how much can you sustain that? And if you see 2-3 quarters down the line, them touching a bottom and then again starting to grow that number 20, 30% or 40%, then there is obviously a turnaround, which means the lending, they're able to monetize the data, they're able to retain some customers in the ecosystem, the lending partners are happy lending that. So the critical number you have to look at is this quarterly run rate of 600 crores, which they reported for third quarter in terms of distribution business revenue. How much sustainable that is, that is going to come down now in the interim and then post 2-3 quarters, can that recover back, is ultimately going to determine the eventual outlook on Paytm and obviously the eventual target price post that.
I want to go from one that you're concerned about to one that you're very optimistic about. Starting with HDFC Bank, are you buying HDFC Bank in the current price? I believe you've reiterated your outlook on the stock and continue to like this. So I'm taking a cue from that and assume that you'd be recommending a buy on the stock.
Really depends upon the time horizon, right? So if it's indeed going to be 6 months, I think the stock is a dead money for the next 6 months, because we actually need to see the actual improvement in performance with respect to margins and overall that flowing into core PPOP growth or earnings growth, right? My call here is very clearly from a 18 to 24-month perspective. We are confident that the bank would engender a process of consolidation, which means loan growth will be below deposit growth. And that could result in improvement in margins and eventually improvement in earnings growth. So that's how I'm looking at the outlook from a longer term perspective. But that process is going to be a slow recalibration exercise where you're not going to see immediate gratification coming into numbers in the next couple of quarters.
On the business front, HDFC Bank, this third quarter numbers were not exactly very exciting. I just wanted to get your sense as to what you picked up as maybe potential positives.
I think if you look at particularly in the third quarter numbers, they did somehow manage to protect margins. But having said that, clearly, I feel the issue has also been in terms of, let's put it this way, over guiding and under delivering, right? So that communication has been an issue which has resulted in such a sharp reaction by the markets. Having said that, I guess the predominant concern in general for everybody in the system has been tight liquidity, and HDFC Bank is also not immune to it. Unfortunately, the timing of the merger has been pretty inappropriate, because it has come at a time when liquidity in the system has tightened very significantly, which has had a corresponding effect on them. The call very clearly is how well they can actually replace the HDFC high-cost liabilities with low-cost liabilities and manage to improve margins in coming quarters.
Right. Suresh, one area that I want to talk to you about, in fact, I'll break this down, is first talk to me about retail deposits. Now, HDFC Bank has led from the front in this space, but they clearly are being or have been facing challenges in the last few quarters from what we've seen. How do you expect the retail lending to move going ahead? Do you think there could be a turn in the space? There could be some sort of positive triggers that could drive the retail book for HDFC Bank?
Retail deposit accretion, 3Q was maybe weak, but 9-month number is still pretty strong, right? So you'll have to look at it more in terms of 9-month number here rather than looking at quarter, because there will always be quarterly fluctuations. 4Q is usually very strong, so we do expect a strong 4Q for them in terms of deposit accretion. I think from a overall deposit accretion standpoint, the bank has done a good job from a standalone flow perspective. The problem here is the requirement or ask rate is so high because of the acquired stock from HDFC Bank, is that it makes life a bit more difficult for them. As far as lending is concerned, they have been a bit more cautious compared to the other banks in the ecosystem. Their unsecured loan growth has been a bit weaker, and that's because they're far more conservative in terms of their underwriting standards and approach towards this. So I guess the retail lending will grow faster, and it should grow faster than the corporate book, and that should be relatively margin accretive over the course of next 12 months. So these are some of the things which they will have to do it on the ground to manage the overall profitability.
Right, Suresh, you mentioned the communication issue as far as the management is concerned. I'm trying to understand this overpromise, underdeliver. Is this a temporary sort of an issue? Have they, in their commentary to analysts, have they sort of figured that maybe commentary needs to be slightly more realistic for the market to appreciate what they're doing at the bank?
No, for that we'll have to wait for the next quarter, right? Currently, the results are over. We'll have to wait. What is the change in stance after the third quarter? So when they report their full year numbers or fourth quarter numbers, we will have a clarity as to what are they looking at it, what is the revised set of guidance going forward. So it's a bit too early for me to actually take a call on that the communication has changed. We'll have to actually wait for another quarter for us to get that confidence that maybe they are on the right track, both in terms of execution or at least in terms of the thought process, and eventually that translating into better communication to the overall market.
Suresh, while we're talking about deposits, managing costs, not enough branches being open, lack of communication potentially from the new management, the 5-year returns on HDFC Bank are not much to write home about either. So while the merger could have just been a couple of years, even before that, the underperformance was fairly obvious for most people to see. What, in your opinion, is going to take for HDFC to do the heavy lifting and actually start moving up? Because this was the darling of D Street for many, many
PPOP
decades,
growth.
for many decades together,
Yeah.
right?
So they have to get the core PPOP growth right. It's very clear. Unless and until that happens, core operating profit, as we said. What exactly happened is even during the earlier years, as you pointed out, their operating profit growth started coming down. Because of the fact that they focused more on corporate loans. Corporate loans were low margin, so operating profit got affected, but at the same time, provisions were low. So the market unfortunately disregarded the ROA that they reported and focused more on operating profits, right? So they have to get the mojo back, and for that, they will have to get back the operating profit growth going ahead, and that will singularly drive re-rating for the stock.
So you think it's fairly valued at this price, Suresh, in that case?
Well, if it is 2 standard deviation below historic averages, how much more can it go down?
That's the question. That's the big question that we all want to know.
Yeah, so it's valued at 12 times PE for a conservative 14-15% earnings growth. So I guess it's still obviously pretty. I never thought I would say this in my entire lifetime, but I'm still saying HDFC Bank right now is the best value stock to own in the banking space.
Makes sense, Suresh. But that's all the questions that we had for you today. Thank you so much for joining us, taking your time out and speaking to us about all these different topics. Thank you so much, Suresh, for joining us, and thank you so much for watching.